The video opens with the premise that the global financial system is not entering a visible, sudden crisis, but a silent collapse. Markets are not closing and there are no emergency announcements, yet deep structural movements indicate a regime shift. The trigger for this interpretation is a concrete action: the large-scale sale of U.S. Treasury bonds by the Reserve Bank of India. The narrative argues that this move should not be interpreted as a technical adjustment or a minor portfolio rotation. It is presented as a rupture signal. When a central bank chooses to significantly reduce exposure to what has historically been considered the safest asset in the world, the implicit message is that something fundamental has changed. The system may continue to function on the surface, but the trust that sustained it is beginning to withdraw from within. The concept of a silent crash rests on the idea that major actors do not wait for official confirmation. They act before deterioration becomes visible to the public. Within this framework, India's action is described as an orderly exit from a system that no longer offers real capital protection. The objective is not yield maximization, but principal preservation in the face of rising systemic risk. The video emphasizes that these movements do not occur in isolation. They unfold in a context where U.S. debt has reached unprecedented levels and where markets increasingly depend on institutional buyers to absorb constant issuance. When one of those key buyers steps back, even gradually, the signal is unmistakable. The structure is beginning to crack. From this perspective, the event is not loud, but it is decisive. It does not mark the immediate end of the system, but the beginning of its reconfiguration. The RBI's bond sales are presented as the first visible act of a broader transition, in which capital stops flowing automatically toward the center of the system and begins seeking refuge outside of it. The scale and timing of the sale are presented as the elements that give it true significance. On January 7, 2026, the Reserve Bank of India confirmed the liquidation of more than $50 billion in U.S. Treasury bonds. This was not framed as marginal. It represented roughly a 21% reduction in holdings between October 2024 and October 2025, an adjustment too large to ignore. The context of the sale is central to the interpretation. It did not occur during a period of low yields or temporary stress, but in an environment of historically high yields. Under normal conditions, high rates attract buyers by offering greater returns. India's decision to sell at precisely that moment is presented as an anomaly that does not fit traditional portfolio logic. The video explicitly rejects the notion of routine rebalancing. Technical adjustments tend to be gradual, symmetrical, and driven by diversification. Here, the move is described as asymmetrical and directional, reducing exposure to the cornerstone asset of the global financial system. This choice suggests that perceived risk is no longer compensated by yield. The core interpretation is that the RBI no longer views Treasuries as a safe haven, not because liquidity has disappeared, but because long-term value has become uncertain in an environment of rising debt and fiscal pressure. The sale is framed as a preventive withdrawal, not a delayed reaction to an already visible crisis. From this angle, the message extends beyond India. As a central bank of a major emerging economy, its behavior functions as a signal to other institutional actors. If one large holder reduces exposure so decisively, the assumption of universal safety begins to fracture. Thus, the RBI's sale becomes more than a financial transaction. It is presented as an implicit declaration of distrust, not expressed through speeches or alarmist statements, but through the most definitive action possible within the system, withdrawing capital from the asset that underpins the dollar architecture. In a normal market, this behavior would have been unthinkable. High yields are traditionally an invitation, not a warning. When bonds offer higher rates, the message is that risk is being compensated. The video argues that this relationship is broken down. Selling into record yields signals that the issue is no longer price, but issuer viability. This introduces the concept of the yield anomaly. When an asset must offer increasingly higher rates to attract buyers, the system enters a dangerous spiral. Rising yields increase financing costs, which require additional debt issuance to service prior obligations. What appears attractive becomes a structural burden. The video describes this as a debt spiral. Rather than stabilizing the market, high yields intensify stress. A point is reached where no rate is sufficient because the risk is no longer financial but systemic. The question shifts from how much the bond pays to whether the system can sustain itself without unlimited monetary creation. Under this reasoning, India sold not despite high yields but because of them. Elevated rates were interpreted as stress signals, not opportunities. They reflected growing difficulty for the U.S. Treasury to find natural buyers willing to absorb expanding debt volumes. The video warns that this dynamic leads to a critical juncture. If rates continue rising to attract demand, interest payments may consume an ever larger share of fiscal revenue. At that point, the system faces a binary choice: allow bond market collapse or intervene through massive money creation to keep it functioning. This is the foundation of the implicit default argument, not legal, but functional. A system that can only survive by issuing new promises to pay old promises loses its anchor. Within this framework, the RBI sale is presented as an early reading of that outcome. It did not react to collapse. It acted before collapse became visible. While India reduced exposure to U.S. debt, the video contrasts this with China's strategy. Focus shifts to China's massive monetary expansion, with M2 reaching $48 trillion, more than double that of the United States. This figure is not framed as recklessness, but as part of a fundamentally different liquidity model. The key distinction, according to the analysis, lies not in how much money is created, but where it flows. In China's case, monetary expansion is described as directed toward the real economy. Infrastructure, mining, manufacturing, and productive capacity absorb liquidity. Money does not automatically recycle into financial markets or foreign debt, but converts into tangible assets and strategic capability. Within this framework, hard asset acquisition plays a central role. The video highlights China's use of liquidity to secure commodities, particularly gold. Rather than accumulating financial promises issued by others, the Chinese system is presented as converting paper into physical resources. Monetary expansion is used not to sustain financial asset prices, but to guarantee control over critical inputs. This contrasts with the U.S. model described in the video. There, money creation tends to inflate paper assets, raising financial valuations without equivalent expansion of productive capacity. Liquidity circulates within the financial system, reinforcing prices, but does not necessarily translate into additional infrastructure or strategic resources. This comparison introduces a broader regime shift narrative. It is not about who prints more, but about what is done with what is printed. In one case, money becomes real assets independent of external trust. In the other, it recycles within a system that requires continuous buyers to sustain value. Thus, China's M2 expansion is framed not as weakness, but as strategic advantage in a world of depreciating fiat currencies. While some convert liquidity into debt, others convert it into control over resources. This divergence explains why India's bond sales and China's asset accumulation are interpreted as complementary movements within the same structural transition. India's and China's actions are presented as two distinct moves that, when viewed together, form a single strategy. The video describes this as a pincer movement against the dollar. On one side, major buyers withdraw from U.S. debt. On the other, debt issuance continues accelerating. Demand shrinks while supply expands, creating structural pressure. In this setup, the bond market becomes trapped. If historical buyers like China and India stop absorbing new issuance, equilibrium breaks. To place remaining debt, the system must offer ever higher yields. Those higher yields then intensify the problem by increasing debt service costs, reinforcing the spiral. The video projects that this combination leads to falling bond prices and sharply rising interest rates, not as a shock event, but as the logical result of altered capital flows. When systemic actors stop recycling surpluses into U.S. debt, the market loses its anchor. This shift is not framed as conspiracy, but as convergence of incentives. India prioritizes capital protection. China prioritizes control of real assets. Both behaviors, driven by domestic considerations, produce the same external effect: structural reduction in demand for dollars and U.S. debt. The analysis identifies this as the essence of the Great Reset, not an announced or coordinated event, but a silent reconfiguration of flows. A system based on trust, promises, and automatic dollar recycling yields ground to one based on physical assets, direct control, and reduced reliance on the reserve currency issuer. In this context, the pincer movement does not need to culminate in immediate collapse to be effective. Changing equilibrium rules is sufficient. Once major actors stop supporting the system, the burden of debt and issuance concentrates on a shrinking base. According to the video, that process is already underway. The next indicator presented as visual confirmation of this shift is the gold cross. The video defines it as the point at which gold reserves in major emerging market portfolios surpassed U.S. Treasury holdings. This was not metaphorical, but a graphical representation of a deep change in central bank priorities. The cross is interpreted as more than reweighting. It symbolizes a shift from a trust-based system to a possession-based one. Bonds represent future payment promises backed by issuer credibility. Gold depends on no counterparty. Its value does not rest on state solvency or financial system stability. The video emphasizes that this shift is neither accidental nor fashionable. Central banks do not chase trends. They respond to structural risk. When gold displaces debt as a primary reserve, the implicit message is that paper security is no longer sufficient. Capital protection overtakes yield generation. The gold cross is also framed as a return to conservatism. In an environment of continuous fiat expansion, physical assets reclaim their historical role as anchors. The visual crossover makes this clear. Less exposure to promises, more exposure to assets that cannot be created by decree. Its importance lies in accumulation. It is not the result of one decision, but of many taken across time and actors. Each marginal bond reduction and each gold increase contributes to a pattern that becomes difficult to reverse without systemic change. Thus, the gold cross is presented as confirmation, not prediction. It confirms that regime change is already materializing within official reserves. The system is not waiting for a visible crisis. It is adjusting in advance, shifting value from trust-based structures toward physical assets. The analysis then advances to what the video calls the return of capital mindset, a framework prioritizing principal preservation over yield. In an environment of ongoing fiat depreciation, this mindset is framed as rational adaptation, not extreme conservatism. The goal shifts from making more to losing less. This contrasts with decades of yield-chasing behavior. While the system functioned, additional risk in exchange for interest seemed reasonable. But when system stability itself is questioned, promised yield loses relevance. Capital seeks shelter, not multiplication. The video places the RBI's decision within this framework, sacrificing future interest to protect nominal value. Here, the dichotomy between the paper game and the physics game is introduced. The former relies on contracts, promises, and institutional trust. The latter relies on tangible assets, physical resources, and real limits. According to the video, central banks are beginning to bet on physics, recognizing that promises can break, but physical assets cannot be printed. This mindset shift is global. When debt grows faster than repayment capacity and money creation becomes permanent policy, paper loses its anchor. In that context, physics, gold, silver, commodities, reclaims its role as ultimate reserve. The return of capital mindset also redefines time. The objective is no longer quarterly optimization, but surviving a prolonged transition without capital destruction. This perspective aligns with physical asset accumulation and reduced exposure to instruments dependent on continuous macro stability. Thus, the video presents this mindset not as emotional reaction, but strategic adaptation. When systems change, rules change. Prioritizing capital and monetary uncertainty becomes logical. Selling debt and accumulating physical assets is not a directional bet, but a way to step outside the blast radius of paper collapse. The practical section of this video focuses on a concrete strategy framed as protection, not speculation, called the 15% rule. It is presented as aligning with smart money behavior. The core idea is simple. Allocate 10 to 15% of net worth to physical gold and silver as insurance against monetary dislocation. The emphasis is on extreme risk coverage, not profit maximization. Such an allocation is presented as sufficient to protect capital in severe fiat deterioration without forcing abandonment of growth opportunities elsewhere. Balance, not concentration, is the objective. The video explicitly distinguishes physical ownership from paper exposure. ETFs and financial metal products are described as carrying counterparty risk. In systemic stress, delivery promises may not equal delivery. Therefore, the strategy insists on direct possession outside the traditional financial system. This distinction aligns with the broader analysis. If the core issue is loss of trust in promises and contracts, replicating that exposure through paper instruments undermines protection. Gold and silver function precisely because they do not depend on intermediaries or third-party solvency. The 15% rule is framed as preventive, not reactive. It does not wait for official confirmation or visible collapse. It is anticipatory. Positioning before transition becomes obvious to the broader market. In that sense, it mirrors central bank behavior. Thus, the practical guidance fits the overall argument. If major actors are reducing paper exposure and increasing physical assets, replicating a fraction of that shift becomes a defensive response. Not an aggressive bet, but rational adaptation to declining trust. The video closes by addressing the Monday morning scenario and the psychological risk faced by most market participants. The warning is not tied to a specific event, but to how information is processed when markets reopen. At that moment, algorithms recalibrate prices based on real flows, not reassuring narratives. Once large buyers exit U.S. debt, models must recognize new reality. Sustained selling, growing deficits, and structural demand shifts cannot be ignored. Adjustment may not be immediate or linear, but it becomes governed by mathematics, not opinion. Against this backdrop, the video warns of media gaslighting. Official narratives and major outlets are expected to downplay significance, framing events as temporary noise or technical adjustments. The goal is to preserve normalcy perception even as fundamentals shift. This introduces the concept of normalcy bias, the belief that because the dollar has always been the reserve currency, it always will be. The video contrasts this with historical examples of dominant currencies losing status not through announcement, but through gradual erosion of trust. The final warning is not an immediate prophecy, but a call to recognize an ongoing process. The Great Reset, according to the video, does not occur in one day or under one headline. It manifests through accumulated decisions, bond sales, physical asset accumulation, and quiet reserve changes. The closing message underscores that the greatest risk is not volatility, but inaction rooted in outdated assumptions. When systems change, clinging to normalcy becomes vulnerability. The adjustment is no longer hypothetical. It is unfolding in real time, whether markets choose to acknowledge it immediately or not.